Hello and welcome to another video as part of the technical analysis series. Today we're talking about entry triggers. Here's the outline for today's video. First and foremost, thank you for your support on the horizontal support resistance video that came out a couple days ago. If you enjoy this series, please leave a like, subscribe, comment, do all that stuff. Let's get back into the algo and get back to work in these treacherous market conditions. Now, to business. We're going to start with a disclaimer where I basically tell you that I'm an idiot and you shouldn't watch the rest of the video. Then we'll get into the main portion. We'll start with some basics. We'll discuss what is a trading plan and what is an entry trigger. We'll cover 6 types of entry triggers. We'll go over some nuances and then we'll conclude. Here's the disclaimer. Pause if you need to. I'm an idiot. This is for entertainment purposes only. Not investment advice, not legal advice, not financial advice, not life advice, not health advice. This is a nothing burger. Just, you know, I'm completely incompetent. Watch this for fun. Now, what is a trading plan? I'll leave a Medium article I wrote a few years ago in the description if you want to follow up. The basic premise is as follows. A trading plan basically dictates the rules under which you engage with the market. So the first, what do I want to see that would confer an edge or form a setup, your kind of expectation. Then with that comes certain parameters. The first is where do I want to get in? Sort of the price at which you establish the trade. And more importantly, an entry triggers kind of answers this question, how do I want to get in should the market start to form a setup that you recognize or that you think confers an edge? And then it's where am I wrong, which is your invalidation or typically your stop placement. Where do I want to get out, which is typically your take profit. And then how much am I going to bet, which is your position sizing and other risk management related factors. Now, generally speaking, trading should be treated as a job and taken seriously. That's kind of why having a trading plan is important. You're not just kind of stumbling out of bed, opening your mobile app and seeing the first thing that's gone up and buying that, hopefully. But you're sort of setting the terms under which you do business. And also, I've noticed over the years that having a trading plan can address a lot of issues that are perceived to be psychological. So you'll have people pulling their orders at the last minute or chasing in the middle of nowhere or just basically acting at random. And they think that it's because their trading psychology is terrible and they read all these trading psychology books hoping that they'll help. And some of those books are decent, but I've just learnt that through discipline and having a clear rule set for the market, a lot of the issues that are perceived to be psychological aren't psychological at all, and they actually stem from disorganization. And once you introduce some organization, those things get better. So if that sounds like you, consider kind of nailing down a bit more on the disciplinary side and having clearer rules for how and when to trade. Now, what is an entry trigger? The definition I've employed here is an entry trigger is a specific set of conditions under which a trade idea materializes into a position. Or more colloquially, it's when you put on risk and change from being an observer of the market to a participant in the market. So the question we're essentially trying to answer, you know, if you're on crypto Twitter or trading related social media, you'll see a lot of arrows and squiggly lines, and basically someone, for example, will have a box. You know, that could be their support, resistance, whatever there may be. That's sort of the premise for their trade. And they'll draw something like this, that the market is going to come into there, do something like this, and then go up. And what we're trying to establish is what on earth goes on here. Even if your analysis is correct or the market is respecting the lines you've drawn on your chart, how do you turn that into a position? Social media doesn't do a great job of this because the squiggly lines and the arrows, etc., give the illusion that there's a clear trading plan there, but it's not as clear on how do you actually put on the position. What kind of orders do you use? What prices do you trade at? Do you ladder in, or what do you do? And it's very important because at the end of the day, your execution is your P&L, right? You need to actually put the trade on to make some money. And so that's kind of the premise behind this video. There are some criteria for what make for a good entry trigger, and they are as follows. Clearly identifiable, so that you can actually identify them when they're happening in real time and trade them. Consistent and replicable, you know, they happen frequently enough to allow you to actually trade and put on those positions. Easy to track and journal. As we've discussed, a large part of this comes to organization, and that includes trade review. So if your entry triggers are completely arbitrary or non-systematic or random, it becomes very hard to track your trades and try to improve your process. They should be closely related to your trade idea and where you want to do business. You know, it's one thing to say, I think I want to take a long trade at 20k, and then the market's at 23k, and then you start trading there. It's like, well, your entry trigger should have a decently close relation to where you think, you know, is a good area to do business. So those two things should be relatively proximate to one another. And lastly, not emotionally driven. There should be a system and a process there. If you're just chasing the market or acting on emotion or cancelling and pulling orders based on how you feel at any one time, it becomes very difficult to quantify any of these things or establish a process which you can then refine to get better. So some things to look out for there, and hopefully the examples we cover cater to those. Needless to say, given this is part of the technical analysis series, the entry triggers presented here are broadly based on technical setups, although the logic can be transplanted to other forms of trading. So entry trigger 1 is outright price, and the definition here is rather straightforward. It's buying or selling using limit orders at a predetermined price or area. So essentially, upon determining the price at which your setup is triggered, you leave orders in the market to trade at that price. It's just your standard kind of limit order, limit buy at a price we think the market's going to bounce, limit sell at a price we think the market's going to bounce. And the way you get into the market is that if the market trades those prices, your limit orders get filled, and voila, you have a position. Before we cover some pros and cons, we'll just quickly go over what that looks like. Again, first the trading view example, then we'll look at some charts. Let's say, once again, our kind of social media example, this is your area of support, or even, maybe a more explicit version is you have a level here where you think the market's going to bounce, and, the market's somewhere up here. You leave a limit order to buy at that price, and if the market comes in and trades there, as this is happening, your limit order is getting filled. And then, if the market bounces, good for you. If it doesn't, maybe you get stopped out, whatever. But the way you transition from observer to participant is that by leaving limit orders at a certain level, when price trades those levels, the rest is done for you. Your limit order gets filled and voila, you have a position. So that's sort of at its core the most basic mechanism at play there. Some chart examples of that. We had the Solana bearish breakdown and retest at 135s, 136s. We wrote about this in Technical Roundup, trletter.com, free newsletter, yada, yada. But the basic premise was, if the market's somewhere here and it's rallying and you're thinking, well, this is support turned to resistance, I think there might be a trade there. Your entry trigger for trading this support to resistance flip, which is the setup, your entry trigger for that setup would be quite simply leaving a limit order to sell at 135.64 in this example. And should the market trade to 135.64 as it did, you get filled on your sell order, and that's your position established right there and then. Similar example for this 4740s handle, move back within the range high here. That's resistance once again. As the market is creeping back up, you might think, well, I have a setup, which is this range high reclaim or move back within the range, turned from support to resistance, and your entry trigger for that setup is to simply trade the level. And the way you do that is you leave a limit order in the market, in this case to sell, and if the market, as it did, trades to that level, you get filled on your limit order, and that's how you go from setup to actually having a position. Rather straightforward. I think there might be one more example. Here's the S&P 500 monthly cluster. Again, something we wrote about in Technical Roundup. I should probably stop saying that. It's probably annoying. Anyway, untested breakout cluster here on the monthly. As the market's floating back, you're thinking there's probably a setup here to play this from support to resistance or whatever else. And the way you engage the market, again, is simply by leaving a limit order to buy at that price handle. It gets filled, and that's your position. And the other examples are for other things. So, obviously, there are pros and cons to certain strategies and ways of engaging the market. The pros to limit orders are as follows, or this kind of outright price entry trigger. Limit orders allow you to control your fill prices, which is nice. As we know from our market microstructure video, which hopefully you've watched, if you're using a market order, the only thing you guarantee is that your full position size gets filled at the best possible price at that time, but you don't get to decide the specific price at which you get filled, because you're taking liquidity from the order book, right? Whereas with limit orders, because you're a maker, not a taker, you kind of get a larger degree of control over what prices you get to trade, which is nice. Another added benefit of that is that limit orders are much cheaper, or typically significantly cheaper, especially over time, than market orders, because limit orders add liquidity to the order book, whereas market orders take them away, and that's usually reflected in the fee structure. And if you run a big simulation of many trades, you'll see that over time, being a maker versus a taker can quite drastically affect your P&L curve and your cost of trading more generally. So that's another benefit. Another benefit is that trading with limit orders just enforces discipline. You have an idea, you have a setup, and you know where it's triggered. If you don't get that price, you don't get a trade. Simple as that. So it stops you from trading ahead of levels that you know are good, stops you from FOMOing in and chasing the market. You have a plan. If it fills, great. If it doesn't, no trade for you, and then there's no sort of ambiguity there. Another benefit, or sort of follow on from that is that it removes the last second emotional discretion where you might start to interfere with your plan purely based on how emotional or scared you're feeling as the market's moving. And this is a very common phenomenon, something I used to struggle with a fair bit as well, where, you know, if we take our example here, where you've got a level at 1400 or 1390s or whatever, and the market's floating down, then up here you think, oh, this is a really good level to buy, I wish I can get a fill there, but instead, as the market starts to come into it and it looks really scary and aggressive, you think, oh no, never mind, this looks so bad, maybe it'll go even lower, never mind, cancel order, and what will often happen, or happen a lot of the time, is that the market might poke a little bit below your limit order once you've cancelled it, and you think, oh, thank God I didn't get filled on that, because I would have been underwater now, and then it does exactly what you thought it might, and just because it looked scary, you cancelled your plan and didn't make any money. Whereas if you just keep your limit order there, it removes that last second emotional discretion, or at least makes it easier to sit on your hands. You just leave the order there, and then you manage the trade once you get filled, instead of just using this final leg of scary price action to completely bail on a plan on a purely or primarily on an emotional basis. So that's good. The kind of discipline that's built into those types of orders. As I said, the last kind of pro here is it's a very straightforward way of engaging in the market. You're simply doing business at your levels. It doesn't take a bunch of thinking. Most of the thinking comes to identifying the areas where you want to do business, and certainly there are other considerations as far as sizing and trade management and profit taking and so on, but purely when it comes to entry triggers, which is the point of the video, it's about as simple as it gets. This is the level, I want to do business at that level, limit order in, full stop. Now, obviously, there are downsides to this approach. The first is partial fills or no fills, even if the idea is broadly correct. So, you know, limit orders, while they do let you dictate the prices at which you trade, there's no guarantee that you'll get filled for the full quantity of your order, especially if price kind of just wicks there or fills some of your ladder or spends very little time there. You might only get a partial fill of your fully desired position size. Limit orders also, to some extent, remove the option to get an even better price if the market pushes deeper into structure, which is something we'll discuss. So for the most part, especially if you get those big scary moves into your limit orders and ones that actually extend past your limit orders, so you know, if your limit orders are sort of outrightly at the level itself and the market sort of wicks quite a bit below, most of your fill is still going to be, in most cases, where your limit order was. And that sort of leaves all of this, or the area, the sort of excess or the push that happened below the level or above your level, which is technically a better entry, that's not available to you. For the most part, your baseline assumption with limit orders will be, if you get filled, most of it will be at the price where your limit order is. And even if you do get the chance for a discount or a better price, a lot of the time, the majority of your fill will come from at your original order, and you'll miss out on all this extra discount and goodness, you know, if you're just trading outrightly at the level itself. And that's sort of the second setup, which we'll discuss in time, but that's certainly one thing to consider for outright price. And the sort of logical corollary of that is that it doesn't immediately cater well for deviation setups or failed break type of setups and other types of market phenomena which extend past levels that are support or resistance. So limit orders is the basic assumption there is this is the level, in some form or another, this level is going to hold. And if you get sort of more messy price action or failed breaks or deviations and all this other stuff, basically the market pushing the boundaries of your structures and of your levels, simply trading the price outrightly makes it a bit more difficult to navigate around that. Another downside is that the invalidation isn't always clear when you're trading with limit orders. The level might be good, but how you kind of define your risk around it might not be as good. So as we'll discuss, and I'm kind of jumping ahead a little bit here, when you get your type of deviation setups, right? Let's say this is your support, the market comes in, and then it looks like it's going to break down, but it eventually reclaims. The good thing about those types of setups is that your risk is immediately clear for the most part, or very often on those setups, because you know you're wrong if the deviation gets violated once again, right? The assumption being this is support, this was the excess, and then this level is support once again. If you're just outrightly trading the limit order and buying the level itself, there may be something you can look to the left to say, you know, this market structure level is going to be my invalidation, or maybe there's some thrust candle there and you can use the thrust candle low as your stop or something like that, but it's not guaranteed. A lot of the time, while the level itself might be good, the risk management or the specific invalidation around that level may be less clear. The last con I can think of, which is kind of 50-50 because it can be a pro, especially if you're a beginner, if you're just leaving limit orders in the market to trade, that removes your discretion in assessing how the market's going to react to your level. Because you simply don't know. You're putting an order in to buy, putting an order in to sell, and by the time the market starts to react to your level, your order's already been filled. right? So you don't get the chance to make the discretionary determination as to is support supporting, is resistance resisting, what's the price action like, is there absorption, whatever else, because by the time you get a chance to observe those things, you're already in the market. So that's kind of a potential con, but again, it can be a pro because there's a lot of evidence to suggest that traders sort of read into these things too much and microanalyze timeframes which they have no experience microanalyzing and end up fudding themselves out of perfectly good positions. Like, come on, colloquially, how many times have we been here where we say this is a good level, the market comes into it, and then we'll jump down from like the hourly to the 5-minute and look at all this kind of erratic-y 5-minute stuff and open and close 10 positions and end up flat, and then then this happens. And so this is what it looks like on the 5-minute, where you've been fudding yourself out, but on the hourly, it just on your original time frame, it kind of just looks like that. And this sort of little chop consolidation excess is where you manage to puke your position like a fool. We've all been there. I still do it to this day. It's very, very common. So that's why it's sort of a 50-50 pro and con, because yes, you do surrender the right to some extent to assess the price action, or at least you're filled by the time you get a chance to look at the price action. But sometimes that can be quite good because your perception of the market on those lower time frames, that chance to discretionarily assess whether the market's doing what you want it to do, can be a downside if you don't know how to manage your time frames properly. I guess the summary version of that is it's not always a bad thing that you don't get to look at the price action, because sometimes it's messy and it can FUD you out of an otherwise good position. Now, what's the recommended context for this type of outright price trading or just trading with limit orders, leaving orders in the market? Again, these aren't hard and fast rules, but generally speaking, as we saw in our examples, the first test, best test at really clear levels types of setups, especially if they're rounded retest setups, lend themselves very well to limit orders. Like, look here, there's months here between the breakout and the eventual retest, and those limit orders were rewarded. And it's the same here with this range high example. It broke back within the range here, and you had like a period of a couple of months, sort of 2-3 months before the rounded retest came in. And sort of true for the S&P as well. This is a really long and rounded retest into this level, and I'm sure there are other setups which we'll discuss or you can find yourself. But in terms of recommended context, where sort of when should you feel confident enough to just leave that order there, in my observation, it's those higher time frame, fresh areas of support and resistance with a lot of time and space between the break and the retest. The second entry trigger 2, is wick price. So outright price for the first one, wick price for the second one. And the definition here is buying or selling using limit and or market orders below support or above resistance. Now, this might sound weird, but the examples we'll cover will hopefully add some color. And the premise here is that markets often wick and rarely stick to technical structure to the very tick, right? So therefore, selling at a relative premium or buying at a relative discount can offer a better entry price. Now, we'll go over this one line, then we'll look at some examples before we go into the pros and cons. And it's as follows. If you think the market will reverse and go up from $1 and you have a chance to buy it at 99 cents, why not buy there, right? And so, again, our trading view ghetto version of what that might look like is, instead of leaving a limit order at the level itself, if you think this 13.95 handle is a good price and the market's coming into it and it's trading, let's say here at 13.80s, it's very unlikely that the very fact of the market trading at 13.80s invalidates your idea. And if you were going to buy 13.90s thinking it's for a bounce, there's a decently high chance that this 13.80s, if your idea is correct, is going to be the wick portion of that candle that you hope or eventually takes you higher. So the idea here is, while 1390s is the level you've identified where you want to buy, you let the market give you a discount relative to that level, whatever the difference is between the level where you want to do business and where you're speculating that the wick might be. All of this extra sort of this gap here is a discount relative to where you wanted to buy. And so the idea is, A, you establish the level that you think the market's going to bounce from, and B, you actually let the market poke below it, and anything below it in your mind is, if my idea is correct, this is the wick and it's a better entry, and therefore I'm going to look to buy there either with limit orders or with market orders or whatever else, right? And the idea is, if this type of thing happens, you manage to catch that much more of the move, not by trading outrightly at the level itself, but by getting more of the wick portion of that candle. So some examples of that. are as follows. This is Bitcoin on its first test of the sort of 19-20k previous cycle's high. We can see that even if you're looking at candle bodies, and the wicks took it to a bit of an extreme, although this does kind of catch the average wick below, none of these tests of 19-20k were perfect. You can see even on the daily time frame there were some excesses and the market didn't respect it to the tick. And if you gave it some more space, let's say on average kind of 4% extra, you were catching much, much better entries than the participants who were outrightly buying 19.8, 19.9k or whatever. So that's just one example. Another one is, I think I've got a BNB chart, and this is the weekly range low at the 210 handle. Again, especially you can see on the first time that when the market really did its final leg down before the 20k bounce, sort of in the summer, the discount relative to the level itself ended up producing the bounce. I mean, that's all well and good, but if you were looking for those types of wick entries, you got as much as a 12% discount relative to the level itself before you got the same move. Now, again, the trade idea is the same, that the market's going to bounce from 210, and it's a question of entry trigger or execution. Are you going to do level at the 210 business? Are you going to do business at the 210 level outrightly with those limit orders, or are you going to go for those types of wick entries by scooping it up below the level in anticipation that A, your idea is correct, the original premise that 210 is going to bounce, but B, you're getting a better entry in anticipation that it's probably not going to bounce exactly from 210, so I'm just going to give it a bit of room, and if I get any discounts relative to that level, that's just a better price and a better deal, okay? Here's another example, this Matic weekly cluster, similar type of summer bottom type of thing. If you did business outrightly at the kind of 34, 38 cents handle, still a great trade and you still caught the upside. But if you had an open mind towards, either trading at the lower boundary or even aiming for the wicks, that's an extra 10, 15, maybe 20%, which can make a huge difference over time when it comes to your lifetime P&L curve. So again, the basic idea stays the same, that the market's going to bounce between 34 and 38. But if you believe that to be true, then buying a bit below it at 33, 32, whatever it may be, is just a better version, a better entry, and like a cheaper deal on the same trade idea. Hopefully that makes sense. And there are some important nuances here, so let's get into the pros and cons. Now, the pros are mostly self-explanatory. You get better entry prices if you're right. They can offer clearer and tighter invalidation, which typically means larger sizing as well, because by definition, if your idea is correct and you got a wick price entry trigger, you're doing business at the wick, and therefore you have a clearer invalidation. You don't need to guess. You're either right or the market probably isn't going to reverse at that type of structure, and that just lets you tighten up your trade parameters a lot. And then again, a sort of upside corollary of that is that it's less likely to squeeze your entry or wick further if your trade idea is correct. And it's really good if you can get trade entries which don't kind of sit on your entry and put you underwater, above water, underwater, above water. It's just psychologically less draining, and it's easier to manage trades where you're kind of above water the whole time. I've just found it's easier to think about the market objectively. Another pro of this approach is it reflects the fact that markets aren't tick perfect and that they wick. So think about any, even in your past 2, 5, 10 trades, if you are buying a level of support resistance, go back at your trading journal, look at those trades. It's unlikely that your level was the exact bottom wick, bottom tick of that type of structure, especially if you're trading higher time frame stuff like dailies and weeklies. Those wick portions of your entries can be 5, 10, if not more, percent that is, compared to your original structure. So if your idea stays the same, but you can get a 1 to 10%, just numbers, back of the napkin maths, better deal on your entry, maybe that's worth looking out for, or at least being open towards getting those types of entries, right? And another kind of upside that's a bit more subtle is it may be easier to get out if you're wrong. So let's take the Matic example, right? Here. So let's say you end up buying closer to the wick, and in this case, the market didn't go up, and let's say this was a bearish retest. There's a decent chance that if the market sort of, you get your entry closer to the candle body or the wick, and then if the market pushed up and started finding resistance on the appropriate time frame where you thought this would be support, that gap is actually profit for you. So it puts you in a sort of stronger position to manage the trade, because even if you're wrong in buying that support, because your entry was so good, you have more bandwidth to manage that trade and close it for profit or close it for break even, or just not eat the full size loss, because your entry sort of accounts for that, right? So it gives you trade management benefits there as well, which are important. Now the cons are also very important. Now, first of all, the very fact of a better price might mean that your original idea is wrong. And especially if you take this to an extreme, it can create a trade idea completely different to your original one. And it's a sort of very basic thought experiment here. If we take our level, and let's say in this case, this 1390s is resistance, and the market, starts to push, and as it's here, you're thinking, oh, this is just, my base case is that this is resistance, the market's going to go down. And the market's above it, so this is technically a kind of wick entry or potentially a premium. And then the market keeps pushing, and you're like, oh, this premium is amazing. Wow, look at all these fills. I'm so lucky. Wow, this is really good. I can't believe I'm getting to catch this wick. And then by the time you're fully filled, if you kind of zoom out and take a fresh look at it, maybe you're just completely wrong on the trade, and this isn't going to be resistance, and instead it's some sort of reclaim that's going to shoot off, or some sort of, consolidation before a leg up, whatever it may be. So if you don't kind of scale your expectations appropriately when it comes to what is the reasonable bandwidth for a wick, and you just keep kind of fading the move and averaging in above the level where you thought the market would go down, you can end up in some gnarly situations where you end up kind of selling a breakout that invalidates your original premise. That's really clumsily put. But basically, when we're talking these wick entries, they still need to be close enough to the original structure to make sense in line with your original trade idea. If you really let the market get away from you and take this kind of wick idea or premium discount idea too far, you basically end up doing business in an area which has no relation to your original trade idea. It's like if you think 1390s is resistance, especially if it's like a medium time frame type of entry, it should be resistance around the 1390 area. You can't then start to scale in at 1500 and say, aha, I'm so clever, this is going to be the 1390s wick, because probably not. This is a question of margins. Are you going to do business at the level itself, or are you going to be cheeky and try to catch a bit extra on the top? It's not a matter of any move past this level because the market's going to do what I wanted to do is a wick, even if it's way displaced from the original trade idea. So basically, all of that rambling to say, don't get carried away. This is an act of refinement and not sort of trying to transform the original trade idea into something else. And this sort of leads me to another con, is that if this is taken to an extreme, or you get basically too greedy with it, you risk missing out on simple setups completely by jostling for a marginally better entry. Laddering can address this somewhat, but at its core, you need to assess whether looking for a wick entry is worth it compared to simply trading at the level. So for example, let's say your level selection is indeed very accurate, and or your perception of where the wick might reasonably form is inaccurate. You may end up in a world where the markets is basically doing this, pushing into your levels, reversing, pushing into your levels, reversing, and it's more or less exactly where you would have done business with a limit order in the first place. But because you're so obsessed with this wick idea and you're taking it too far and not scaling correctly, you thought the wick would be up here and tried to sell that, and instead got a no fill, or here you thought the wick would be here and instead got a no fill, and because you're trying to catch an extra 1-5%, whatever it may be, especially on lower time frames, you end up missing out on the trade idea completely, which doesn't make any sense whatsoever. The final note I'll say on this type of wick entry technique is you need to scale it appropriately to the time frame you're dealing with. So if you're dealing with really fast outsized moves, a higher time frame, liquidation driven, you need to give it more breathing room. 5, 10, even 15% on that type of stuff relative to the structure isn't unreasonable. However, if you're dealing in a more normal environment and smaller rotations and lower timeframes, it might just be a question of sort of 0.5 to 2%, if that, relative to the structure that you're trading. So, if you're like trading the hourly chart, there's no point saying this is resistance, right? Let's say this is like an hourly chart and this is your resistance. There's no point saying, oh, I'm going to try to trade it 15% higher than it is, because for all intents and purposes, if it goes there, then this probably wasn't resistance in the first place. Right? So your expectation of where you might be fishing for a wick should be somewhat in line with the time frame you're trading. Higher time frame, more space; lower time frame, less space. The risk, the main con with this wick price idea is simply taking it too far and not being reasonable with it. And that sort of leads me to the recommended context, is this works best when it's dealt with in first test, best test setups at really clear levels, similar to the first one, but especially if it's outsized moves and liquidation driven kind of momentum into do or die levels. So it's really at the extremes where it makes sense to sort of be fishing for wicks, especially really fast and scary moves that are driven by those types of flows, as opposed to on your kind of day-to-day basis. Hopefully that makes sense. Entry trigger 3, deviation. The definition here is buying or selling using limit orders and or market orders, and there are two parts to this. Once price has moved past and then fallen back within the boundaries of a support/resistance structure. So again, this is similar to the Wick price entries, and it sort of acknowledges that price action can be messy, and this particular type of messiness is such that price often exceeds the boundaries of the areas where we want to do business. So for example, if we go back to our standard trading view type of thing, if this is our resistance, an example of a deviation might be if this is, our level of resistance, the market comes in, and the next time it actually pushes through the level and then flatlines, consolidates, and eventually falls back within the structure. So again, there are two ingredients when it comes to a deviation type entry trigger. One is excess or shooting past the original structure, which is this portion here. And the second ingredient is then moving back within or closing back within or being accepted back within the original structure, which is here. So for example, if you see a breakout, this is our level, and, again, resistance, and then you see a breakout, and you're asking someone here, hey, is this a deviation or not? The answer is you don't know until it falls back within the structure. The act of failing to be accepted back above it and or falling back within it, that's what's quote-unquote confirms the deviation and then kind of triggers this entry technique. You could technically start to speculate whether this is going to be a deviation by looking at the higher time frame context, maybe looking at a footprint and seeing if there are signs of absorption. But for our entry trigger purposes, it's a two-part process. One is the excess, but you only know it's excess once it's moved back within the original boundary, right? So some examples of that. Let me just close these for the time being. Here we go. The Bitcoin all-time high breakout was a classic example of a failed breakout, whether you want to use the actual all-time high or this range high structural level. The market attempted to break out in its new all-time high and then eventually fell back within those parameters, and the weekly closed back below it. You even got a late kind of impulse here. I remember this wiped out like all of the open interest, which was a crazy signal. But that's one example. So this is your boundary. Portion 1 is the excess, and portion 2 is closing back below the boundaries, right? Here's another one, the infamous Terra Luna buying BTC breakout attempt. You've got this triple top of resistance coming in. This is the breakout. It's like, how do you know it's a deviation? Well, you don't. When do you know it's a deviation? Purely technically speaking, on this weekly candle here, at least on this daily time frame candle here, when it closes back within the range. Two-part step. 1, the break. 2, reacceptance back within the original parameters, right? And I think these are, let me see really quickly. Yeah, more deviation type of setups for ETH, similar at its all-time high. Range high, looks like a breakout, fizzles out, closes back within the range, finds resistance there, closes back below. Again, through the structure, back within the structure. And same here on this attempted breakout. You've got resistance, support, kind of a nice level at the 3000s. You have a breakout, excess through the structure, and again, closes back within the structure, and this ends up being your deviation when the market falls back within its parameters, right? Now, the pros and cons here are as follows. Probably the best thing about this type of setup and why I personally like it so much is it presents a very, very clear invalidation for any trade idea that you have. As we discussed, the premise of these deviations is that, the market typically doesn't double deviate, right? So if we take an example of this as support, you have support here, and the market comes back, excess, and then back within the range. Immediately, 9 times out of 10, your invalidation is the original excess low made once the structure you started with has been reclaimed, right? This is your go-to sort of built-in invalidation. And there's a video on the channel titled Overthrow for Stop Loss Placement or something like that that covers this in more detail. So that's really a good thing. And from an invalidation point of view, as soon as the market starts breaking below this level again, you could start to exit, and certainly your hard stop at the invalidation low, if it goes anywhere near what should have been the trap, then the idea is cooked and you're most likely wrong. What's far less common is, for example, especially if you have like very clear levels and higher time frame and you're dealing with clean structures, what you don't see as much is, let's say you have resistance here, ends up a break, deviation, and then it ends up coming back above the level and then deviating it again. Like these types of double deviation structures, they either happen on like much lower time frames, or a lot of the time it just means your structure sucks. At the very least, on the balance of probabilities, these double deviations are far less frequent than anything else. And even if they do happen, your risk is still primarily, at least your starting stop loss, is defined by the highest high made on a failed breakout or the lowest low made on a failed breakdown. So even in the rare case that you do get like an extra squeeze, it doesn't really change your invalidation to start with because it shouldn't violate the highest high made. And then again, even if you do get this type of thing, you simply adjust your stop to the most recent high or to the most recent low, right? All of that to say, that is one of the main benefits of these types of setups. What makes them really attractive is that the invalidation becomes very clear. And you have an added bonus when it comes to the pros for this type of category, is that generally speaking, there's a higher probability that these sorts of deviation setups end up working in your favor, because the excess that is created by the deviation ends up being a sort of manifestation of trapped participants, right? So if we just sort of go back to markets microstructure 101, if we have our level here, this is our resistance, this is the breakout, and then the market trades back below the level. All the participants that were buying on this leg up, they're now underwater, right? They bought this breakout, they're now at a loss because the market's here, whereas the average entry is here. And so if the market starts to creep up, we can expect them to sell their position or puke them for break even. Or even if the market doesn't creep up, they might be forced to forcibly close their positions, especially as more savvier traders start to sell that down, recognizing that they're trapped and they'll have to do something. And so trapped longs closing turn to shorts, and then you also have shorts entering the market recognizing that these guys are trapped, and that sort of creates a lot of selling pressure. So the benefit of having types of deviation types of entry triggers is that you have some extra technical confluence on your side that the setup is going to work. And also, quite logically, it's easier to compound the position once the deviation is set because you know exactly where you're wrong, and that makes it easier to sort of trade around an area and adjust those parameters. Now, there are some cons to this type of setup. The first is that sometimes support just supports and resistance resists, and there's no deviation, and then you get no setup. So again, the core assumption of this type of deviation logic is that you will get something like an excess, and then you get to trade the backside of it in one form or another. But sometimes you'll just have a level of resistance, and the market will come into it and just completely crap itself. And so the people who were trading the limit orders at the level or whatever else, they're eating well, right? Because they just had a level, they sold the level, and business as usual. And in some of the Solana examples and the others we talked about, there was no such deviation to speak of. It was a straightforward, this is resistance, it got there, it got smacked. This is support, it got there and got smacked. So sometimes you don't have the luxury of the market offering you this very technically clean, identifiable failed break or failed, like excess. Sometimes you just don't get that. You get a very quick reaction at the level. It does its job, does what it says on the tin, and good night. So you end up missing sometimes on really clear and fast resolving technical setups if you're always waiting for a deviation. Like, the market doesn't have to do anything. Sometimes it'll attempt to break and fail, then you get a deviation setup. Sometimes it won't, and it'll just puke. And for you, if you only have that as your entry trigger, that could manifest in a mistrade, right? The other con is that when you're dealing with these types of setups, it requires more discretion regarding your order types. So once the deviation is confirmed, like, how do you actually get on board? Do you market sell the close or / the move back within the range? Do you limit sell the deviated level? Do you do both? It can be quite tricky. So, in this example, this is our level of resistance once again. Market comes in, and then market closes below, and this is our close. Like, technically, this confirms the deviation, right? Because it's our two-part experiment. Did it exceed the level? Yes. Did it close back within the level? Yes. Aha, deviation confirmed. But how do I get on board? Do you leave a limit order at the original level so that when it retests, you get a fill there? Do you just market sell as soon as it closes as a deviation, and then you have your risk set, hoping for continuation? Do you do both, where you set some sort of market sell position as a starter, and then you add if it gets to the level for your full position, hoping then it rolls over? That's for you to figure out. For me personally, if I'm trading these types of setups, for the most part, if it's a very aggressive type of move where it engulfs straight through the structure, I'll typically market sell that for my full position size, and if it wants to come back and retest, that's fine. If it's more of a rounded type of deviation, like the Solana one, where it's like deviated and then it spends some time and then it comes back into the level, I'll usually let this leg go and then look to trade the rounded retest with a limit order at the level itself. But that's definitely something you have to figure out. How do you get on board? You don't have to pick one or the other, but as long as you have rules of engagement for trading these setups, that's all it takes. And again, you are afforded a bit of a break by the fact that your invalidation is set by the highest high made in the bearish scenario, or the lowest low made in the bullish scenario, right? Sort of lowest low made in the bullish scenario. Your risk is here. So you certainly get some options when it comes to how you engage the market for these types of setups. Now, some of this will just be learning. Like, for example, I've had before very clear deviation type of setups, like this is support, it breaks down, no acceptance, shoots back above and does this. And I'm thinking, oh, great, this is a deviation. Excess through the structure, reclaim of the structure, that ticks both of our boxes. That's a deviation setup. And then what I would do is I would leave a limit order to buy the original level of support, you know, something like this. With a stop at the deviation low. And instead, what the market would do is just kind of consolidate, maybe come down a little bit, and then shoot off. So my original setup was correct. My idea was right. My expectation, all of that was in line, but it just didn't pull back far enough to the structure to give me a fill. Whereas obviously I've had it before where I would just mark it, but, you know, I'd get a very strong type of deviation signal where it would come up and it would shoot up completely, and I'm like, oh hell yeah, I'm gonna market buy this thing, and I end up entering on the close back above that type of structure, as long as the, you know, whatever, at least it's, let's say it's at least 1R, and then what would happen is the market would then pull back to where I'd normally leave a limit order and then shoot off from there. Now, that's not the worst thing in the world, because in most cases, if your stop placement is reasonable, you don't end up getting taken out on this. But this is all kind of, this difference between where my market entry was and where my limit entry would be is all money and expectancy you leave on the table. So it is tricky. You basically have to study your setups and look at what would be the fill rate if I left the limit order. What about the market order? What's the impact on risk reward on my setups of using market orders versus limit orders? How displaced does price get from the original level where I want to do business? All these things are for your trading journal, but that's just one of the cons kind of worth considering, is that just because you identify a deviation, it doesn't guarantee a way of trading it, right? You still have to kind of get in once the market's shown you that, hey, support is still support or resistance is still resistance. And I guess I covered the last con somewhat implicitly, is it can greatly reduce the risk reward or make the trade unavailable if the market moves too much from the structure. So that's one of the inherent cons of not doing business at the level itself, is if you wait for the market to move, by definition, you're further away from the structure where you're doing business. You're typically further away from your invalidation, and that can affect some of those built-in trade parameters that we talked about. In terms of recommended context, I think range-bound markets are really good for deviation types of setups, because the core assumption of range-bound markets is that support's going to support, resistance is going to resist, and any breaks through value won't be accepted by the market. So that's one thing, and also just levels that have been traded before. So less so for first test, best test type of stuff. I usually try to get in on the first reaction of those, especially if they're one of those long rounded retests. But if we're dealing with levels that the market's been trading before and where you've had participation in the past, having an open mind, an open eye towards these deviation setups in those contexts is really good rather. Entry trigger 4, break and structure. This is my least favorite and one I used to trade sort of in 2019, 2018, but I sort of stepped away from it. And there are people who are much better than I am at doing this type of stuff. You know, your trader mains, your trader SZs, and so on and so forth do this much better than I do. Well, frankly, because I don't do it as well, but, you know, it certainly works for them. And the definition here is buying or selling using limit orders and or market orders once price has shown sufficient evidence of low time frame weakness at resistance or low time frame strength at support. Now, essentially, this setup concedes that the structure may not be attractive enough to trade outrightly, so it's not clear enough, not good enough, contextually not attractive enough to just leave a limit order there and get filled no matter what, but that view can be swayed with further evidence, and that further evidence is typically price action based, which means sort of on a core level, higher highs and higher lows at support increase the likelihood that the setup is going to work. Lower lows and lower highs at resistance increase the likelihood that the setup is going to work. So typically what you see with those types of setups is someone will identify a high time frame pivot. Let's say this is your initially your daily level of resistance here at this 1460 handle. And then what they'll do as the market is coming into this level and actually starts pushing and trading it, they will then jump down a time frame to their execution time frame. Maybe it's the hourly, right? Oh, this is painful. Maybe it's the hourly, maybe it's the M15, maybe it's the M5, maybe they just open up a footprint, whatever it is, and then they will assess this price action as it's developing, but not on the original time frame of the level, but on a much lower time frame, so they get more candlesticks, more data, and a more granular view of what's going on. And then once they've kind of zoomed in on the lower time frames as to what's going on at this higher time frame, they'll typically look for signs of weakness, which at its most basic is bearish market structure of lower highs and lower lows. So looking for some evidence of absorption, weakness, whatever it may be, in order to get on board there. Now, the pros and cons, it's a bit of a mixed bag, right? So the pros of this is that it prevents you from taking trades where the market just blitzes through the area you were planning to trade. Because by definition, you're waiting for evidence to see what happens. So for example, we've all been there where we've wanted to sell a level, right? Let's say we want to sell this level here as the market's coming into it. And then it, pushes. And then the next candle looks like this. And you think, oh, for fuck's sake. And, if you had a limit order there, you're not having a very good time. Even if you had like a Wick type of snipe you were looking for, you're not having a very good time. So this does happen in trading, and it's completely normal. Maybe it's a news release or some other volatility catalyst, and your level just gets completely blitzed. That's kind of part of the game, and there are certain mitigation strategies, but you will eat shit on those setups from time to time. Whereas the pro of just waiting for price action means it's much less likely that happens, because you're giving the market a chance to prove to you what the price action is going to do there. So that kind of delay in engaging the level can prevent you from falling victim to those types of wipeout candles, which is definitely a pro, right? The other one I can think of is you basically get increased confluence from price action aligning with what you want to see. And that's sort of the point made by the 2 bullet points above, that, if you're seeing bullishness at what should be support, that shifts the odds in your favor. If you're seeing bearishness at what should be resistance, that also shifts the odds in your favor. Now, there are also some cons to consider, right? The first, as I sort of alluded to, the fact that I don't use this a lot myself. The most I'll do is maybe if I've got like a wishy-washy daily level, I might go down to the hourly and look for a setup there. That's something we'll discuss a bit later. But this is still difficult to do in practice, especially if you're trading really higher time frame levels like the weekly or the daily, maybe even the monthly. You will get an especially low signal to noise ratio if you start staring at every single low time frame candle at high time frame structure. Like, bear in mind, sometimes when you're dealing with weekly levels, they can take weeks to resolve. Like, if I have a weekly support and the market prints 2 weekly candles there more or less at the level and then reverses, that's completely normal. But if you're looking at that level like on the 1 minute or the 5 minute, as soon as it gets there, that's a lot of chop with no ultimate resolution. So there's a real risk there. Another con is that it can turn into a momentum chasing game, realistically, which is basically like, if you have a level that you think the market's going to do something like this resistance, and then the market gets to that level and starts to break down, instead of trading at or around the level itself, you end up trading significantly sort of displaced to the level after the market's already moved. And so in one form or another, you do end up chasing it. Now, that's completely fine, as long as you sort of know where you're wrong, and as long as there's enough downside or upside to capture to make the risk reward worth it. But it does end up into a bit of a chasing game where, you're waiting for red candles to sell and looking for green candles to buy, which like can be okay. But if you're in an environment which is less forgiving and the rotations are smaller, like by the time you actually get visible momentum or signs of strength or signs of weakness, sometimes either just the move is done or the risk reward is too shitty to chase the market at some point, and most of the leg has played out. So that's something to bear in mind. And that's sort of the other con I note there, is that entry prices can become quite detached from the original idea. If this is the level you want to trade and you only get your real momentum breakdown much lower, let's say here somewhere, all of this comes in the form of gains you've given up by trading away from the level for more confirmation as opposed to trading at the level itself. So there's definitely like a delicate balancing act there, and sometimes that's a very tricky one to get right, at least for me, purely honestly speaking. Another thing I don't see people discuss enough when it comes to these types of break and structure trades is that it precludes you from taking trades where the reaction is swift and immediate. And it comes to those types of setups we discussed earlier, where sometimes the market will just fly into one of your levels and then get completely smacked and disappear. And there's no room for market structure to develop or something like this, or clear momentum to come in. And you're either trading at the level itself or you're not trading that level at all, because it basically solves itself, or the trade resolves in 1 or 2 candles, 1 or 2 time periods, or in a very short period of time. So a lot of the time, basically waiting for shifts or breaks in structure is a luxury. And a lot of the best trades, in my experience, especially when it comes to fading big moves, they simply don't give you that luxury, and they move way too quickly, and you're either on board and you smacked it at the level or you didn't. So you can miss out on some absolute sitters, especially if we're talking about those fresh rounded levels, if you're not comfortable trading the level itself and instead waiting for confirmation or a break in structure. And again, you can greatly reduce the risk reward and make the trade unavailable, which is sort of the implicit point there. The recommended context for these, I'd say if you're like really experienced, that's probably the first one, because most beginners, I think, would be better off just doing business at the level itself rather than waiting for the market to show them whether it's support or resistance. broadly speaking, when you're unsure about the quality of the structure, like, oh, this is like okay-ish support or okay-ish resistance, and also like in tandem with not having a directional bias, like let's say it's the range midpoint, and you're kind of like, like, you know, it's 50-50, it's a complete coin toss as to whether, you know, my expectations for this market, then you can say, okay, I'm going to need more evidence to shift the scale on this one, and that evidence will be lower time frame momentum when it gets to the level. So I think it's reasonable in those contexts. But for me personally, my bias is always towards trading as close as I can to the structure itself. So any types of entry triggers that get me further away from where I think I should be trading, I generally treat with suspicion. It's a completely fine strategy. Some people pull it off really well, and we'll cover some examples a bit later where that works. But just be aware of the implicit trade-off there. And another implicit trade-off that we'll cover, but I think I should kind of face it now, or sort of preface this point, is that there's a sliding scale to be aware of, generally speaking, that the more confirmation you get or want, the worse price you get for it, and the less confirmation you have, the better prices you get for that. So if you're waiting for confirmation and waiting for all the momentum in the world to suggest that resistance is going to resist, all the red candles, all the oscillator signals, like by the time that actually turns into a trade, the meat of the move is likely at least like a third done, halfway done, if not entirely finished. Right? Like there's no free lunch in markets. If you're going to wait for resistance to resist, or if you're going to wait for support to support, a lot of the time you're giving up better entries and better prices. And again, that trade-off is completely reasonable and can work, especially if contextually there's like a lot to capture and you know, there's plenty of the move left. That's fine, but just be aware that it's not some sort of hack or free lunch where you can just wait for the market to tell you if it's going to go up and be able to buy it with no repercussions, or wait for the market to tell you it's going to go down and sell it with no repercussions. There's always a cost to these things, and in this case, the cost for confirmation is price. Entry trigger 5, candle close. Very straightforward. The definition here is buying or selling using market orders, primarily, once price has closed in the appropriate direction at a support resistance structure on a given time frame. So your kind of classic TA 101, buying a close above resistance, buying a close above support, selling a close below resistance, selling a close below support. Now, the base case here is that when you're engaging this type of framework, the candle close that you're looking at should take place on the same time frame as the technical structure. So if you're looking at a daily chart and daily levels, you should be looking at daily closes to give you signal. And if you're looking at a 4-hour chart, you should be looking at 4-hour closes to give you signal. Now, you can refine that over time and sort of try to anticipate how the higher time frames are going to close by getting hints on lower time frames. But sort of this system a lot of the time works best at its simplest when you don't really mix and match time frames all too much and you stick to the time frame which the idea comes from. So some basic examples. And maybe we'll do the last bit first in terms of recommended context, so these examples make sense. It's really good for reducing noise in high time frame swing trading. So, you know, cast your mind back to the example I made earlier, where sometimes these daily and weekly charts can take days and weeks to unfold. And if you're staring at them on the 5-minute time frame, you're going to take 50 trades with price not having moved at all. And by the time it actually does, had you just waited for the high time frame close, the signal would be far less choppy and just, you know, rather straightforward. And I think it's also good for clear momentum plays when it comes to big crypto breakouts or breakdowns through key levels. A lot of the time, just kind of tagging onto the candle close through that type of structure makes a lot of sense. So let's look at some. Nope. Talked about this. Yes. I think these were some of the this is a deviation and the candle close example. So we have this S&P 500 range low at 36s, you know, 36.80, 36.30, thereabouts. We had a close below that structure, what should have been a bearish retest, etc. Market didn't follow through and then closed above that level here. So purely on a candle close basis, this is a reclaim. And even if you bought the close, you spent basically no time underwater and caught this big impulse here. The reason I included this example is not only for the candle close type of setup, but this is also a really good example of the deviation thing we talked about earlier, where you have a level. What's our 2-part checklist for a deviation? Excess through the move, yes. Close back within the move or the original structure, yes. But then if you just left a limit order at the original structure, you would have gone unfilled. Whereas if you left a market order, yes, your entry price would have been worse, but at least you'll have a position, unlike not having a position had you just went for the limit order approach. So that's kind of a good practical example of that trade-off in action. But yeah, as far as candle close type of stuff goes, this is a classic example. When it comes to crypto stuff, again, one we wrote about, I probably shouldn't say that, whatever, it's a free newsletter, goddammit, trletter.com, go read it if you want, or don't, it doesn't matter, it's just, this is how my brain works, it compartmentalizes things. This is the weekly ETH level at 1900s into the merge, previous range high, range low, breakdown retest, rounded retest on a sort of weekly candle close basis. You had a close below resistance here, and even sort of if you chased it next week, you know, your entry wasn't amazing if you waited for like the most obvious candle ever, but given, you know, this big inflection point, that wasn't the worst idea in the world, right? I quite like when my candle closes are actually relatively close to the level itself, as long as the close is decisively clear. A lot of the time, if you get a close that's just way too far from the level, like if this were just a wick and the candle closed, the original one, let's say closed like here, a lot of the time what you'll see in the coming periods, whether that's hourly, daily, weekly, whatever, is the market will come in and fill a lot of that wick closer to the original level itself before moving lower. So I don't like, if I'm going to trade candle close swing trading signals, I generally like them to be somewhat close to the level itself, because if it looks too wicky, too crazy, a lot of the time that just gets filled and I can get a better entry than chasing the close, especially if we're dealing with like daily, weekly stuff. So that's a good example. Another one is this ETH daily chart. You know, you had a clear shelf of resistance at this 1200s level. The first daily close you got above. You know, if you're leaving a limit order there, no dice. But if you're using a market order on the close, you have like a tiny day of drawdown before catching this entire impulse here. Another one, again, I like my closes to be close to the level itself. This is this 1400 prior cycles high. Comes in, looks really scary, but look, all the closes happen right at the level, which is something I generally like. If all these closes were happening, let's say up here, I'd be thinking, well, there's a chance I might get my limit order filled, so, you know, you have to make that trade-off in your head. But if all the closes are good, i.e. in the direction that you want, and they're happening pretty close to the level you're looking at, that's generally a pretty good sign, and, you know, caught that move there. And same when it came back to give a rounded retest of this structure. It did give a pretty nice wick retest later on before the impulse, but again, the close candle close setup on the first test best test ended up being quite useful and at least gave you a move into the first trouble area. And needless to say, a benefit of the weekly close being rather close to the structure is that it's much easier to contextualize your risk reward in that way, or at least you're much likely to be closer to invalidation because you're trading closer to the level itself. So that's something worth bearing in mind. Some more weekly time frame stuff, and I think this one demonstrates the point most pertinently about wanting those closes to be close to the level. Sorry, it's really annoying saying close and close. This is the BNB range low. Weekly close here. In the direction you want it, but not like, you know, it's not closing up here. It's still like contestable, but significant enough to tell you that support is supporting. You've got a couple of tests later on the week, but in any case, the entry is more or less the same. And then you've got your nice move into resistance. And if you look at the move into resistance, very similar here. This is something we're going to talk about, sort of previous week's high and previous week's low. So leave a like on the video if you want to see that video quickly. But more or less, basic premise here as well. You had a weekly close. You know, if you use this as a hard stop, you definitely got shafted on this move. But purely kind of candle structure speaking, you're still getting no weekly closes above resistance. So no reason to think that the market was going to move higher at that juncture. And a good one on AVAX as well. The kind of two levels come to mind. The first is when this range high was finally reclaimed. You know, if you waited for the weekly close above that type of structure, yes, it did come back and retest the level a little bit, but in any case, not a huge difference between this weekly close entry and the wick entry. Both ideas are more or less the same, and you got nice continuation there. And very similar to the downside, actually, once the market closed below this range low, and, you know, at that point, things were looking pretty bad as well. You got a very straightforward continuation signal to the downside. So purely on a swing trading thing, if you're like, this is a big level, closed above it long, this is a big level, closed below it short, it may not feel comfortable at the time because you're not like exactly sniping the market or doing whatever else, but for higher time frame swing stuff, it certainly can be useful. I don't know what this Rag and Rock playthrough is doing. Let's just close it. Sorry about that. So let's look at some pros and cons now. So the first one should be self-evident, is that these things are generally easy to identify. not all the time, and that's, it may seem somewhat contradictory, but the good ones are generally easy to identify, although sometimes the closes can be ambiguous. If they are ambiguous, just look at other entry triggers or look at lower time frames or do something else. But the good ones are generally easy to identify. The second pro is that they're easy to backtest and even automate to some extent. So as far as getting data for your trading journal across like all time frames or testing strategies, candle close stuff works pretty well and is pretty easy to do in that regard. And one of the main benefits I mentioned is that it avoids a lot of the low time frame noise when high time frame swing trading, which is really important. The cons are as follows. The closes can sometimes be ambiguous, so at that point you just have to look at price action, as I said, on other time frames or employ other tools. On a sufficiently high time frame, candle close signals can be very late or trigger once the move is done. So sometimes, if you're waiting for quote-unquote confirmation with the candle close, and by the time you get the close, the market's up like 20, 30, 50% or down as much, there really isn't a lot left to capture. So contextually, again, it's the same trade-off, right? If you want more confirmation, you get worse prices. And sometimes those prices are so bad, or I should say so displaced, that the original trade idea is no longer tenable or valid. So that's always the trade-off that should be on the forefront of your mind. What price am I paying for this confirmation if I'm waiting for confirmation? And the last one, of course, that's sort of implied. By the time the candle closes, the risk reward may be greatly reduced, or the trade is done or is somewhat unavailable. And this issue crops up especially in like high time frame swing trading and breakout trading, where if you're going to say, I'm going to wait for the weekly close, and the weekly close is up like 50%, that there still could be something there depending on the context. But especially on those higher time frames, it's probably a good idea to have faster moving signals as well to let you get on board, even if the close itself makes it too late. Recommended context, as we sort of covered at the beginning, reducing noise in high time frame swing trading is like 95% of it, and then clear momentum plays as well, not too dissimilar from the first point. Entry trigger 6, slow time frame fractal. Shout out to my friend Trader Mayne, Mayne. Go watch his YouTube channel, Twitch, TikTok, whatever stuff. This is basically his entire trading system, where he's got like, and actually on the Technical Roundup channel, I did an interview with him where he explains his entire trading system, and this is basically what he does. I used to trade in this fashion a bit more again in 2018, 2019, less so now, but it is very popular and worth being aware of how to use these things, and I'll still kind of jump into the weeds from time to time on lower time frames in a similar fashion. But the definition here is buying or selling using market and or limit orders once price has formed a lower time frame buy or sell setup within a higher time frame area. So this is the classic top-down approach and a sort of a small variation on the break and structure entry trigger. And let's go over the basic outline first. We'll kind of do some doodles on TradingView and then go over the pros and cons. So the basic outline is as follows. You identify a higher time frame area to do business. This could just be a higher time frame level, or a lot of the time this system is particularly useful is if you're dealing with a broader higher time frame zone. So if you're dealing with like a 5, 10, 15% price range on like a much higher time frame, like an area to do business, this approach really helps you refine and narrow that down in order to make it more tradable, because no one wants to trade a 15% range, right? That's a lot of drawdown just from one side of the range to the other. So this is a way of kind of being more precise with it and making it more practical. You wait for price to reach said area, that high time frame zone, then you go down to a lower time frame, or typically again as stated the execution time frame, which could be from the 5-minute to the hourly or whatever else, and you wait for a lower time frame setup to form within the higher time frame structure, and then you execute. So let's go over an example. Let's say we have a weekly area, right? Let's say we have a weekly zone here, and this is what it looks like on the weekly time frame. Now, you might, if you measure this out, this might be like a 5, 10% range, whatever it may be. And you want a bit more precision rather than trading a 5, 10% range. Now, what you typically do is if you then go down to the 5-minute, what will normally happen is that same weekly box actually looks way bigger, right? Because you have the same range on a smaller time frame. The entire zone gets larger. And then the question becomes, well, I don't want to trade this whole thing. How do I pick an entry? Which part of this do I trade? Where within this do I get an entry trigger? And the answer is you basically wait for low time frame setups to form anywhere within the higher time frame zone, and you execute on those lower time frames knowing that you've got kind of high time frame confluence because of where you're doing business. So for example, let's say this is an area of resistance, and one of the patterns you trade is a classic overthrow or deviation or failed breakout type of thing, right? Something like this, where you're looking to sell the right shoulder, or the original, the reclaim of resistance, whatever it may be. So now, again, to recap what we've done, this is a weekly level, right? This is like our weekly box here. We've gone down to a lower time frame, which made the box bigger, and now we're looking for lower time frame setups within a higher time frame area. And then as the market comes into it, you're waiting, it's doing whatever, it's low time frame price action in a high time frame area, and then you see something, you see your setup. You see this, right? You see this trigger, and you're thinking, shit, okay, now that's my entry trigger. Whereas before, you were like, where do I sell? Do I sell this? Do I sell this? Do I sell this? Do I scale in the whole thing and just leave limit sell orders throughout the entire structure? The answer is no. The answer is you wait for a setup that's formed contextually, while yes, on lower time frames within a higher time frame zone, and it's the setup, it's the low time frame setup that ends up being the trigger for the larger idea. So if this is one of the setups that you trade, as soon as you see that form, again, within the boundaries of where you expect resistance in one form or another, that ends up being your entry trigger with the built-in invalidation. And then in doing so, you've managed to narrow down this entire range into a specific entry, a clear invalidation, and then you have the benefit of swing trading to a larger target, because you're not just expecting an intraday move from one side of the range to the other or whatever else. Remember, this is our weekly structure, so we're expecting it to go down to some other weekly level of resistance, right? Hopefully that makes sense. Now, what's the balancing act here? So the pros is that you get to balance, if you manage to balance low time frame entries in higher time frame areas, they can give you really tight invalidations. So instead of, if you've got like a 10% weekly block range, whatever it is, instead of going spray and pray on the entire 10% and just laddering limit orders or praying, selling the bottom of the range, and you have to eat a 10% drawdown because it goes to the top of the range or whatever it is, you give yourself a more precise entry and a more precise invalidation. So that's always really good. And again, you're having you have a low time frame entry for a high time frame swing trade. So the risk reward for that stuff ends up going up, ends up increasing exponentially. And that's sort of the second point, front running myself as usual. It can increase the risk to reward and narrow down entries when dealing with wider areas. Like you'll see a lot of analysis on Twitter, which is completely reasonable. They'll draw out like a larger weekly area somewhere. Let's do some random stuff. Let's say they've delineated on the weekly time frame this consolidation here, right, as some mega meltdown support between 420 and 470. And the question becomes, well, where within this range do I buy? Or even if we take this little cluster consolidation here, right? I think this is a good example, actually, because this is one that I was looking at the time. This sort of 2 to 300s level, this entire pre-breakout cluster. And then the question is, if you're going to treat this as resistance, as the market comes back into it, where in that consolidation do you do business? Because if we measure the size of this consolidation as the market's coming into it, you're like, oh, this is resistance. Like, which part of it, bro? This is a 20% box, right? It's a 20% box. How on earth am I supposed to know where to sell it? The answer becomes, well, brother, you go down on the lower time frames, like your daily or even your 4-hour or whatever else, and then you find setups on the daily or the intraday within this area that allow you to define your risk in a more narrow way. So you don't have to you don't have to sell the whole box or treat the whole thing as resistance. You simply wait until you get a lower time frame setup, and then the lower time frame setup dictates your entry and your invalidation, and then you still have the benefit of trading it to higher time frame targets. Hopefully that makes sense. There are obviously cons to this. The first is difficult to do in practice. It's the same issue of having a large signal, or sorry, in this case, a low signal to noise ratio if you're staring at low time frames at high time frame structures. Again, I've got a video coming on top-down analysis so that you get your timeframes right. There is also a timeframes video on the channel, but leave a like if you want to see the top-down analysis video come out soon. The basic idea is if you're going to mix and match timeframes, you need to be somewhat reasonable with it. So if you're trading monthly levels, maybe just look at the weekly time frame for your setups and not the 5-minute. If you're trading weekly setups, maybe just look at the daily or the 3-day time frame or the 12-hour or whatever for your setups instead of the 1 minute. If you're trading the 4-hour chart, maybe look at your 15-minute to 1 hour instead of a tick chart, and so on and so forth. There needs to be some sense of proportionality between the time frame that you're using to generate the trade idea and then your execution time frame. If they're too disparate and too wide apart, then you just end up getting lost in the noise, and that's not good for anyone. And yes, it also has the same issue as some of the other techniques where a lot of the time good setups will just play out way too quickly. And if you're waiting for setup to form and a bunch of price action to unfold, so on and so forth, sometimes the market will just smack the level in reverse and you're none the wiser for it. Recommended context, I said, look at Trader Main stuff. Trader Z does this well, Trader XO, all your normal price action blokes take this pretty seriously and have a lot of content and resources around it, so check it out. Yes, finding more precise entries in a wider high time frame area is the main benefit of this type of entry trigger. There are some nuances I want to cover. The first is that these categories are not mutually exclusive. So, for example, you might have, if we take the extremes, let's say a deviation setup and a limit order setup, right? Let's quickly draw this out. They're not mutually exclusive. So you might, for example, as we discussed, get a deviation type of setup where the market comes in and reclaims support, and then you leave a limit order at the then deviated level, right? And the market comes in, hopefully you get filled, the market goes up. You can also mix and match. Again, the example we use is where if you get a deviation setup, you may wish to open some of the position with a market order as soon as the deviation is confirmed, and then you leave a little bit on the limit order side of it if the market comes back to the original level. And it gives you a better average price. The invalidation is the same, and the idea is the same, just with a higher likelihood of getting some fills or whatever else. So when it comes to these entry triggers, it's not like you only have to use one, or it's one per setup, or they're somehow contradictory. You can mix and match and use both, use neither. You can jump from one to the other, right? So for example, let's say you have a limit order idea, and the market comes in and just completely craps through your level, and you get stopped out, but then eventually it turns into a deviation, right? And maybe you can limit buy the same level again, or maybe market order as soon as it reclaims and it goes up. So even though you went for a limit order entry trigger here, you end up going for a market entry here, even though it's largely the same trade idea. So it's not like you're sort of bound to use one, or the fact that one got stopped out means you can't use another entry trigger. Different conditions, contexts, and setups will likely require slightly different entry triggers, not a one-size-fits-all. And this is something, again, to learn from your trading journal to some extent, experience, observation, so on and so forth. I will say on the experience front, beginners should lean towards simpler techniques first, because you don't have the experience and the discretion to do all this low time frame stuff and the nuances involved there. I would say start with the simple stuff, like mostly just the limit order strategies, if anything, or the candle close strategies, and then refine as necessary from observation and study of your trading journals and other tools to reflect on what on earth you're actually doing. I would say don't use entry triggers as a precursor for cowardice. I just see this a lot nowadays, that people are trying to avoid taking risks. Like, oh, if it confirms, I'll do this. If it confirms, I'll do that. It's like there's no such thing as a free lunch. You know, there's always a price to pay for confirmation, and you end up kind of narrowing the band of trades and the parameters of those trades you can, that are available to you by quite a fair bit. The market pays you to take risk. The uncertainty is the whole name of the game. So be wary of anything that just makes it sound like you can't lose. If true confirmation existed with no downsides, no one would ever lose money, and people obviously do. So that's something worth bearing in mind as well. And it's, again, the same sliding scale I alluded to earlier. Less confirmation generally means a better entry. More confirmation generally means a worse entry, which is fine, but it's just a calculation you have to be aware of and make sense of, depending on, the size of the move, how much is there left to catch, the relative risk to reward, so on and so forth. Some trades will require you to mix and match. Again, we went over the example where you have like a sell, it gets invalidated, and then it turns into a deviation, and you can take more than one trade and more than one entry trigger at the same structure. There are no rules against that I'm aware of. And the last thing I'll say on entry triggers is this is the very core of trading. It's how you execute. Like, this is very serious business. As much as we love squiggling on charts and entry techniques and looking smart, at the end of the day, you have to get in and out of the market and bring your plans and your squiggles into fruition. And that's what entry triggers, that's what this entire topic is about. Take it seriously, study it, give it time, experiment with it, and it's much more likely to be the source of edge than how you draw your lines or where you draw your boxes. That's it. Conclusion. Thanks for watching. If you're enjoying the rapid onset of the technical analysis series, let's get a bunch of likes on this video, and I'll gauge, going by the response, I'll see how quickly I have to get these out. Hope you enjoyed them. Thank you for sticking by the series for so long. Leave any comments and questions. I'll try to get back to you. And yeah, any feedback and sharing and all the normal stuff is much appreciated. Hope everyone's doing okay, and I'll see you much sooner rather than later for some more stuff. Take care. Thank you. Bye-bye.